All right, friends, welcome to you all around the world. Welcome to Follow the Money Radio. So grateful to have you here along for the ride today. As you heard, my name is Jerry Robinson. I'm an economist and author of the book Bankruptcy of Our Nation. I'm an investor, a trader, a trading coach, and the founder here at followthemoney.com, a website that is very much dedicated to helping individuals just like you become better at investing, better at trading, better at generating income for the future. Very, very powerful tools and resources that we have here for our members. And today we're going to be talking about the Federal Reserve's big pivot. If you were watching the FOMC press release, or let alone just the stock market yesterday, you know that the financial markets apparently liked what was coming out of the Fed's mouth, what their new policy announcement was basically saying. We're going to break that apart here in our very first segment, because I want to spend a little bit of time explaining why what the Federal Reserve said yesterday is important, what Jerome Powell, the Fed chair, had to say, but then also what it means. And then in segment 2 today, we're going to dive deeper into how the financial markets have been responding. We've had a banner year in 2023. I mean, we really, really have. If you look at the different markets, we've had some really great returns. We're going to break those down, talk about what's been happening in the markets, provide a little bit of commentary as well. So buckle up, get ready. We're getting ready to dive into a very powerful episode today. Let's dive right in. Well, the markets are surging here in the final weeks of 2023, and a lot of it has to do with what the Federal Reserve has been saying, or perhaps what we should say they haven't been saying. And that's our first topic of the day, the Fed's pivot toward rate cuts. So Federal Reserve Chair Jerome Powell yesterday during the final FOMC policy meeting of the year announced and basically gave a clear signal that the era of interest rate hikes has come to an end. So Jerome Powell, usually very cautious in his statements, has admitted that the Federal Reserve Board is now considering rate cuts as a response to the risk of maintaining rates too high in the face of declining inflation. So yesterday, and I'm recording this podcast, by the way, on Thursday morning. We would normally record on Wednesday, but we were waiting for the Fed's announcement so we could really kind of crunch all of the data and be able to provide you with an update on that, because this is the last policy meeting for the Fed of 2023, and we expected it to be a doozy. So the Federal Reserve held rates steady on Wednesday. They did not raise them. We've been hearing a mantra from some circles in Wall Street that we were going to have higher interest rates for longer. You might have heard that, higher for longer. If you watch financial media or you CNBC or read Wall Street Journal or whatever, the big debate over the Federal Reserve was that, the idea is that the Fed can't lower interest rates anytime soon. It has to leave them elevated because inflation will just simply roar right back if they begin to cut. Well, that is not what the Federal Reserve said in their presser yesterday. As we expected, the Fed left interest rate targets untouched, as I mentioned, at the conclusion of its two-day policy meeting on Wednesday, but it also raised its economic outlook. So every few meetings, the Fed will also, in addition to announcing any kind of new policy in terms of interest rates or discount window or whatever, they will also release a summary of economic projections, which usually includes that thing that they call the dot plot. And in essence, what the dot plot is it shows the potential scenario for rate cuts, rate hikes, what the Fed individually, what all the different individual board members are kind of forecasting as they look forward into to the future. So it's a summary of economic projections. Now, the Fed raised its economic outlook, pointed to positive trends. It pointed to slowing inflation, which we've certainly seen a slowdown in inflation since the 9% peak in the official CPI number back in June of 2022. We've also seen very positive wage growth overall. We have a cooling labor market, which I think the Fed wants to see. The unemployment rate remains solid, however, and that's really created this favorable backdrop for rate adjustments, for the Fed to begin lowering interest rates. And so, as we see the effect of Powell's words, we see that basically the new economic projections and the press conference yesterday, many are viewing as dovish. And that sparked a major market rally on Wall Street. The Dow Jones Industrial Average crossed above 37,000 for the very first time and hit a record high. Yields on the 10-year Treasury note fell down to near 4%, which we haven't seen in some time. And so what's happening is that the perceptions of a rate cut being closer rather than later are being intensified. And because the market tends to look forward about 6 months, you're beginning to see the market rally as it expects those rate cuts. And we're going to talk more about, as I mentioned, we'll talk more about, some of the specific financial markets and how they performed in 2023 in segment 2. So stick around for that. But, so what's driving the change? I mean, let's really just drill down here and say what's going on. Well, Powell, in his presser yesterday, attributed the pivot to the swifter than expected decline in inflation. So projections that the Fed has released indicates a decrease in core prices, which is something that the Fed pays very close attention to. And Powell also tried to stress and get across to the listener and really to reassure everyone that the Fed's remains very much committed to closely monitoring inflation. But he did express some satisfaction with the progress that had been made so far. And I think that they probably do need to pat themselves on the back, even though in many ways the Fed helped stoke and create this inflationary crisis that we dealt with through 2022 for the most part, through its mishandling, quite frankly, and it admitted that they mishandled the interest rate regime in 2021, leaving them too low for too long, and then, of course, stoking quite a bit of inflation from all the government and fiscal spending that was going on. And so what you end up with was, pretty high inflation in 2022, causing people to complain. Obviously, nobody likes paying double for their bread or their eggs or whatever. And so now we're beginning to see that, that the Fed is beginning to rein this in through their policy. Now, some people expected that the Fed was going to have to raise rates to 15 or 20%. They envisioned some sort of, Paul Volcker scenario for those who remember the Fed back from the 1970s and 80s. But in reality, that's not what happened. And I think many who were comparing this inflationary crisis here in the post-COVID era to the 1970s and trying to see some sort of similarity between the two are beginning to see that that was a flawed view. And so we're dealing with a unique kind of situation here. It's obviously inflation. It's obviously spending too much and, poor interest rate policies and everything that have really helped aggravate this. However, this is not the same as some of the different episodes that we've seen in the past. So we shouldn't expect the same outcome the same way. So, let's talk about the broader economic picture for a minute. The U.S. economic outlook is showing signs of improvement. As we mentioned, inflation is coming down. Wage growth is also slowing down, which is also good news for inflationary pressures. And the Fed, in its projections now, envisions a reduction in the federal funds rate target to around 4.6% by the end of 2024. All right. Well, that's basically equivalent to about 75 basis points or 0.75%. So investors are already predicting an 80% probability of rate cuts starting as early as March. And that actually coincides with our own view. We had expected that we would see rate cuts earlier rather than later. We've been in the camp that said that the Fed would cut sooner rather than later. And we did not expect interest rates to get, wildly high. In fact, for the most part, we were watching the U.S. dollar to really inform our views. So now the latest projections from Fed officials indicates a potential scenario of 3 interest rate cuts in 2024, basically each one of them being a 25 basis point rate cut. And that move is, as I mentioned, attributed to a faster than expected improvement in inflation. Now, when we look at the long-term target rate for the federal funds rate, the expectation is that it's going to be around, 2.5% over the long term. They expect that these 3 rate cuts will bring the current rate down to about 4% roughly in 2024, maybe a little bit more, and then below 4% as we get into 2025. And of course, those are current market expectations put out by the Fed. Those are obviously very flexible. They're going to evolve as the economic data points ultimately evolve. And so, as we look at what the Fed is facing, it really is quite challenging. They've obviously, as I mentioned, they've kind of created some of these problems themselves. So they're kind of fixing their own problems, and they've admitted this. One of the big problems that the Fed could actually face as we go forward is that they make the same mistake that they made back in 2021 and 2022, where they sit on their hands too long. And it did seem that the Fed was very cognizant of that. Yesterday, watching and I always watch these pressers when they come out. I pay attention. I've been a Fed watcher now for a long time, and you usually don't pay too much attention to what they say. You really pay attention to what they do. I think that's why so many people, so many investors seem to got the wrong picture from the Fed throughout 2023. While the markets were going up, we had told our members at the beginning of 2023 that we expected some really big gains, from the NASDAQ and from Bitcoin and a few different areas in 2023, because we saw there was so much negativity in the market that that we could see some pretty big short squeezes, and we could begin to see people kind of turning around and changing the narrative. The narrative could get changed. And so because the Fed sometimes says one thing but then does another, if you're not really attuned to how they work, they can kind of throw you off. And so anyway, the big problem here, I think the biggest problem that I see as I look at the current situation and what the Fed has had to say, and I was quite frankly relieved at what I heard from Powell during his press conference and answering questions. One of the questions that came up, and I'm not going to play it here on the podcast episode today, but one of the questions that came up was, you guys admittedly waited too long in 2021 and then 2022 to begin raising rates, even though you saw inflation getting out of hand. You waited too long. And so then inflation got out of hand, and then you were like playing catch up, right? And so the fear is now, and the concern I think that many have, is that the Fed is going to do the same thing on the downside, right? So in other words, the Fed has raised interest rates. This obviously can stress out the economy. It can cramp the economy. It can put some problems into the economy, because the higher cost of money can obviously just create tensions and problems. And we quite frankly haven't seen the entire impact of those higher interest rates due to something we call the lag effect, which quite frankly has gotten longer due to the way we approach policy now by here in the United States. So that lag factor could be quite a few months, in fact, even over a year. And so that means that we haven't seen the full effects now of the Fed's tightening, even though their last rate hike was, 4 or 5 months ago. So the point is that when they begin to cut, that lag effect is still in place. So when they cut, it doesn't just automatically change everything. So it's going to take some time for those cuts to take effect. So in other words, they got to get something right. They've got to get this timing right, where the Fed aims to avoid both waiting too long to cut rates, risking a recession, and then cutting rates too soon, which could potentially fail to curb inflation and cause it to go back up. So they got a really delicate balance here. And that's crucial for sustaining economic growth and employment. So to determine the right timing and the extent of rate cuts as inflation has fallen further than anticipated after recent rate hikes is kind of the unique challenge that the Fed is facing right now. I would certainly say that the Fed has come out of this better than some would have had expected, but they still have to land this plane in a way that doesn't end up taking us backwards instead of forwards. We could have not so soft of a landing, to use economic speak. However, it does seem that the Fed is going to be cutting rates, and they didn't seem to be holding off on that talk. There was a concern that the Fed was going to stay very stringent and very stoic in its rate hikes, and it was going to, not be responsive to the data, and it was going to leave those interest rates elevated and then obviously create a recession or aggravate a recession, and then be too slow to start cutting them. And then that is exactly the same problem they had in the beginning. So the Fed seems very sensitive to that. I noticed from the language from Jerome Powell that all of the Fed board members are focused upon not being late like they were in 2021. So that indicates that they may err on the side of bringing rates down and then, trying to do that a little earlier, being aware and cognizant of that lag effect that can certainly cause and impose problems that may have been unforeseen. So I don't think there's any reason for the Fed to be declaring victory here. We want to steer clear of premature declarations of victory over inflation. Instead, Powell and the Fed seem to be highlighting the need for a careful and nuanced approach in 2024 to its policies. And if you look at the economic projections that were put out by the Fed this week, you'll see that the Fed expects basically a restoration of economic normalcy normalcy or some sense of it over the next couple of years. Say by 2025, they envision that the real GDP growth rate is going to be around 1.8%, which is pretty anemic, but nonetheless, it's kind of been standard. That's not really abnormal for the U.S. 4.1% unemployment rate. That's up marginally from today's 3.8% rate. So that's not really a big deal. The PCE inflation rate, they envision a 2.1% inflation rate. That's down pretty sharply from today's nearly 3% rate. And so, again, the Fed seems to be expecting that it's moving the economy in the right direction through its policy. And so far, the financial markets seem to be confirming that. So now that the Fed's historic rate hike campaign has been concluded, we continue to think that now is a perfect time. And in fact, not just now, earlier, we were saying earlier in the year to our members, we're going to see a pivot here. We don't know exactly when, but we expect it probably by Q1. December was when we expected the potentially earliest rate cut. And we didn't get a rate cut, of course, in December, but we got the next best thing, and that is a promise of a rate cut, right? So in other words, they finally began talking about this. They're beginning to thaw in their hardened view of rate hikes. So declining interest rates are going to serve, in our opinion, as a tailwind for many asset prices, including stocks and cryptocurrencies and hard assets, well into 2024. And obviously, the financial markets like the Fed's plan to begin slashing interest rates in 2024. So on the other side of this break, we're going to return with an update on how the financial markets have been responding here in late 2023 and actually for the whole year. And then I'll also share some of my latest commentary and insights. So stick around and we'll be right back. Hey friends, Jerry Robinson here from Follow the Money Radio. Are you ready to unlock the secrets to financial independence? I invite you to join me for a complimentary 20-minute discovery session. It's your chance to dive deep into our 5 levels of financial freedom and get answers to your burning questions. Together, we'll craft a roadmap to your financial success. Don't miss out on this exclusive opportunity. It's a limited time offer. Visit our website, followthemoney.com/coaching to schedule your free 20-minute session right now. Your financial freedom journey begins today. Well, it's beginning to look a lot like Christmas on Wall Street with the stock market on fire here in the final weeks of 2023. We had a brutal, bruising year in 2022, and 2023 has been the flip side of that bear market. In fact, this week, the Dow Jones Industrial Average hit a new all-time high. You go back and you look at the 3 major U.S. stock market averages, the Dow Jones, the NASDAQ, and the S&P, all of them up for the last 6 consecutive weeks. We've had an incredible rally across the board in the stock market. Now, the beginning of the year, many people were talking about how the Magnificent Seven or the Magnificent Eight, whatever the number is, all the really big top market cap companies like Apple and Google and Nvidia and all of these just having a big year and really leaving a lot of the stock market out of the rally. Well, that's really begun to change over the last few months. We've begun to see the participation broadly span out across the market. So it's no longer just tech and consumer discretionary stocks that have been driving the rally, but we're beginning to see even those beaten down utility companies and consumer staple stocks and even some real estate stocks and healthcare stocks really beginning to participate and enjoy this rally as well. And also another thing to keep in mind is that there were a lot of people in 2023 who, due to something we call in psychology, and especially trading psychology, is something called recency bias. Recency bias causes us oftentimes to think that what has happened, maybe over the last year has to continue happening. Despite all evidence, despite all data, it has to continue to be that way. And that's something we call recency bias. And that, I think, also played a pretty big role explaining why so many bearish bets backfired in 2023. Many of the institutions on Wall Street were wildly bearish in 2023. In fact, in some cases, historically bearish. So obviously falling prey to that recency bias. That the idea is because we have had these economic problems, and because we have had and suffered from inflation, and because the Fed has raised interest rate levels, that this means that there can't be any kind of quick resolution. It has to stay this way. And so many people just started, bearishly betting against the market. And we have seen an incredible implosion of bearish bets. So it's been very expensive to be a bear in 2023. So too, we have around $5.7 trillion sitting on the sidelines in money market funds, that according to the Investment Company Institute. And that is a lot of money that's sitting on the sidelines that was really scared away from the market in 2022, and all of the, negative sentiment that was around the market drove people into cash. And understandably, because cash became a pretty good place to be in 2022 and especially 2023 with rates elevated. The problem is that the stock market has come back with a vengeance. And so, for example, with the NASDAQ 100, one of our favorite markets here, one we've been trading and investing in for a long time, it's one of our favorite niches. That particular market is up 52% year to date in 2023. So you really begin to think about the opportunity cost here. You say, well, I could put my money into a 5% CD, right? And you say, well, that's pretty good. It's hard to find a 5% CD. At 2023, we began to see a lot of them. And so people said, well, I'll take this cash, that's sitting in the market. And because it's so low, I guess the market's not going to go back up again anytime soon. So I'll go put it in cash and wait for all this crisis, to go away. Well, the problem is that, had you put your money in that 5% CD, well, you would have got 5%. That's true. But if you took it out of, say, something like the NASDAQ 100, well, then you missed out on a 52% gain in 2023 year to date. And that is, in essence, 10 years of 5%, CD gains, right? So in other words, you'd have to have your money in a CD for 5 years to get what you just got in 11 months from the S&P, or nearly 12 months from the NASDAQ 100. The S&P 500 also up very nicely. In fact, let me just go through the top 10 markets here. Then I'm going to explain some things. These 10 markets that we track for our members, there's many other markets. These are not the only markets, but these are some really important markets that we track. And out of all these 10 markets, these major markets, the best performer was Bitcoin, up 158% so far year to date in 2023. That's a great gain. However, we expect more gains and even better gains next year, obviously due to the halvening and due to the Bitcoin ETF spot approval and all spot Bitcoin ETF approval and all of that. But then the second, and coming in second place, was Ethereum, which is the second largest market cap digital asset behind Bitcoin. That one is up 91%. Simply incredible. We were telling our members about Ethereum way back when it was at $12. We've been a long time holder of Ethereum, and that one has turned out very well. What a great return in 2023. Then we have the NASDAQ 100, the Invesco QQQ Trust, ticker symbol QQQ. That one we just talked about, up 52%. Driven by a big surge in big tech stocks and some of the S&P 50 stocks, some of these really big, massive market cap stocks. The S&P 500, which we track through the Spider S&P 500 ETF SPY, that one is up nearly 25% year to date, 25%. So you could have just simply bought the S&P 500 ETF, and you could have earned, in essence, 5 years of gains from what you would have had in that 5% CD. So people are looking and saying, I don't have to go out and take a massive risk. I don't have to go out and take on single stock risk and buy like a stock and have it possibly go down. I could just buy an index fund like the S&P and earn 25% in 2023 year to date. That's much better. And I think when people have their money in cash, all that $5.7 trillion sitting on the sidelines in money markets, there's opportunity cost. So yeah, sure, you got some safety, perceived safety there with the FDIC insurance, and you get the 5%, guaranteed gain for your money. However, when you begin to see what you're missing out on in the stock market, that's what causes the money to flow back into the market. And I think we're going to see that in a fairly large way. We're already seeing it right now, but I think we're going to see even more of it in 2024. Another thing that has done really well just over the last little bit. All year long, the Russell 2000, that is small caps, just struggled. And it was just struggling in this range-bound area since 2022. Well, it's finally showing signs of breaking out. And this morning, as I'm recording this broadcast, I see that the Russell 2000 has staged a major breakout above a key level that we've been talking about all year long, which indicates that there is probably much more upside now for the Russell 2000. We track the Russell 2000 with the iShares ETF, ticker symbol IWM. That one is up 15.4% year to date, and it struggled for every bit of that. However, we suspect that the small cap space is going to be a pretty rich area in 2024. Lots of makeup to do there. Gold, another big market that we track, up about 12% so far year to date, recently hitting that record high. Then we have the U.S. dollar, which is up around 4% this year, but really, it's really shaved off some of those gains. It's fallen fairly sharply from its peak in 2022. And so the dollar has been falling. Silver up basically just about 0.8% for the year to date. So it really hasn't done much. It's done a lot of up and down, up and down, up and down. Gold has far outperformed silver so far year to date in 2023. That may turn out to be different in 2024. We may see silver outperform. We'll be watching that. Finally, two more markets we track. Oil, we typically track it with the Invesco Oil Fund ETF DBO. That is down 2%. That's after we had a banner year for energy stocks and oil in general in 2022 when we saw crude oil here in the United States hit $130. We have since seen that price come down dramatically. In fact, I'm looking here at West Texas Intermediate oil this morning, trading at $72 a barrel, so way down from its peak. And anytime the West Texas Intermediate crude oil falls below 75, we consider that to be bearish territory, and that's where we are right now. We may see a slight rebound, but we don't expect much more in the way of higher crude oil prices anytime in the near future. Same thing with Brent crude oil, which is more global oil prices. If you look at those, anytime those are below 80 to 85 range, we consider that to be a bearish moment, and that's exactly where Brent crude oil prices are. Well, anyway, they're flat on the year. And then finally, China, which we track through the S&P China ETF GXC, kind of a low volume ETF, but it really gives us nice exposure to everything we're wanting to track. That's down about 11%. So China's still, having a tough time. We suspect that could turn around in 2024, but we're not incredibly sure about that. So, when we look across the board, we see that the Dow has hit all-time highs. The stock market averages are up over the last 6 consecutive weeks. Bearish bets have been backfiring. You got $5.7 trillion sitting on the sidelines in cash, waiting to re-enter the market once we get the all clear. I would say the Fed meeting this week indicates to many investors that they've been given the all clear signal, which means we could see more money pouring into the markets throughout the remainder of this year, which we only have a couple of weeks, and certainly as we head into the new year. You have the bond market in big rally mode. Bonds have had one of the very best months in the month of November than going back to the 1980s. It's been an incredible month for bonds as interest rates have fallen. We see small caps, as I mentioned, in breakout mode. They're on fire. You have the U.S. dollar faltering after rising and causing so many problems with asset prices now beginning to fall. That's going to serve as a tailwind for assets. You have gold recently touching a new record high. We suspect that will continue to move higher as we move into the coming months because of the weakening U.S. dollar. We have crude oil falling for 7 consecutive weeks amid record high oil production here in the United States. Many people aren't talking about this. They don't realize that the United States is producing more oil now than Saudi Arabia or Russia, and that we are exporting to the tune of somewhere about 4 million barrels per day from the United States. That is more than almost every OPEC nation that's out there. So we are major exporters and have record oil production in the United States right now in the month of December 2023. And that is complicating the picture for OPEC. It's making it difficult for them to continue to manipulate the market when they have this massive gush of U.S. oil, just basically complicating their scheme. And then, of course, we've had the biggest returns in cryptocurrencies, which is something we've been talking about on this podcast for a long time. If you've been listening to this podcast since the beginning, you heard about Bitcoin when Bitcoin was trading for less than $200. In fact, some of our members even bought it for close to $25, okay? If you've been listening to this podcast for any length of time, you know that we talked about Ethereum a long time ago whenever it was trading for $12. That's where we bought it. That's where we started, and our members began buying it. So we've been talking about the crypto space for a long time. There's a lot of new Johnny-come-latelys that are experts on the crypto market, but we're happy to sit here and just continue to monitor it from our perch and to continue to provide you with updates. We see more upside, in fact, great upside for crypto as we head into 2024. Bitcoin breakout, we see an Ethereum breakout. We see a lot of great opportunities there for those who want to be in that space. Remember, when we invest in crypto, we have a few rules that we follow, and I encourage you to learn more about that at followthemoney.com. You can learn all about our different plans and pricing, but we provide a tremendous amount of information on cryptocurrencies, stocks, ETFs, currencies, all kinds of different things available on our website to help you stay on the right side of the trend. So we are also, speaking of that, we're going to be releasing our 2024 market outlook at the beginning of January through one of our live webcasts for members only. And if you want to be a part of that, you need to be a member. Right now, we have a really good holiday sale going on for all new members. You can go to our website, followthemoney.com /join. There you'll see the plans and pricing. But I want to encourage you, if you miss this rally in 2023, and you know that you have to do something when it comes to investing and protecting your wealth, we encourage you to tune in to what we're doing here. For all of our members, we're providing a lot of great insights. We've had a lot of great feedback from all of our different calls and ideas in 2023. Some of the very best ideas we put out last year included Bitcoin, which has done so well. We were telling our members we were buying NVIDIA all throughout 2022. Taking advantage of the sell-off, buying it even when it was down, to close to $100. It was a wonderful opportunity to be able to add NVIDIA, and of course now it's had this massive 200% plus run in 2023. We just put out also a really interesting idea on a call option that is already up fantastically well. In fact, I looked at it this morning and it's doing unbelievably well. So there's been lots of ideas we're putting out. If you're looking for ideas, we put out daily ideas, weekly ideas, we get weekly newsletters. I mean, you get everything as far as investing and trading when it comes to Follow the Money. Lots of great info. So if you're interested, go over to our website, followthemoney.com /join, and make 2024 an incredible year of learning and profiting from your knowledge. Welcome back to the final moments here of today's broadcast. And you may have heard the sad news that Charlie Munger passed away late last month at the ripe old age of 99. He was just about 1 month shy of reaching his 100th birthday. And for those who are unfamiliar with Charlie Munger, he was an American businessman and astute investor who served as Warren Buffett's sidekick and right-hand man in running Berkshire Hathaway. During his lifetime, Charlie was generous in sharing what he had learned after decades of successful and sometimes not so successful stock market investing. And as we conclude today's broadcast, I want to share 3 quotes from Charlie that I think will really encourage you and give you insights into his investing wisdom. The first quote, he says this: "A great business at a fair price is superior to a fair business at a great price." It's a really great statement. To think about it for a minute, but a great business at a fair price is superior to a fair business at a great price. Very, very good advice for those in the stock market. The second quote that I wanted to share was this one I find to be very true. "The world is full of foolish gamblers, and they will not do as well as the patient investor." I've long taught you that patience is absolutely vital when it comes to investing and even trading. So I cannot concur with this enough. And then a third and final quote as we conclude our podcast today. The big money, Charlie says, is not in the buying and in the selling, but in the waiting. And I think that those who have held through 2022 and then even buying during that big fire sale that we had and then held through 2023 and are now seeing the markets return to new all-time highs, I think that they can certainly concur with this statement that the big money is not in the buying or the selling, but it's in the waiting. And those are just some wisdom keys for you to think on as we close out yet another amazing year here at followthemoney.com. I wish each and every one of you a very Merry Christmas and a Happy New Year in 2024. And we look forward to returning with many more great podcast episodes next year. And I want to thank each and every one of you for your listenership. May God richly bless you and your family this Christmas season. And remember, when you want the truth about the global economy, just follow the money. Have a safe and prosperous rest of your year, and we'll see you right back here at the beginning of 2024. God bless, and we'll see you then.
Contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decision.